Okay, before we begin, a little bit of news about Arbor Realty. You can see the Yahoo quote here. It closed yesterday at 13.44. After the market closed, some news came out. We can see it in pre-market, up 5.5%. And that news is that Arbor is set to join the S&P Small Cap 600. And this will happen before the opening of trading on Friday, June 23rd. Which means that every fund manager that has as their benchmark the S&P 600 must now buy ABR. So much for that short report we saw earlier by that hack company. In the market update video, I had mentioned that I had tried an audio AI. So what you do with it is you upload a video of your own voice, or you upload a sound of your own voice, and it then will imitate your voice. So it was ready. We gave it this script, and all it had to do was read the script. So what we're trying to do is we're bringing Rodney back, which is our cartoon angel, and Rodney says stupid jokes. But we don't want to have to keep hiring a voice actor every time we want a voice. So I thought, well, if we hired a voice actor for a couple hours, got their voice, trained the AI on their voice, then the AI could simply just be the voice from there on. But we needed a test to do it, so I uploaded my voice. It did a really good job copying my voice. What you're about to hear is not my voice. It is AI reading this script. The problem is the bloody thing can't read the script and just makes up words out of nowhere, so enjoy. Gibber, this is a test. Gibber, see if this applesauce. Press gibber, gibber not, gibber there, gibber who, gibber to the door and find out, gibber back, if gibber forgotten about me. I am Rodney, your most stereotypical guardian angel. Okay, time for a jabber. Where do gibber bears keep their money? In a gibber. Hey, have a haunt jabber. You get it. Snowbank, because they live in the jabber. I have another one. What would gibber be without bees? Gibber, gibber, disappointment. Why did the gibber fall over? Because it was too gibber. I gibber, you laughed at this one. All right, jabber, continue to the video. Okay, let's get to some answers to some questions from the last market outlook. And before I begin, let me clear something up here. I have not turned bullish. The macro backdrop, in my opinion, is not one that is supportive of economic growth being much more than where it is right now, which is low growth, which is not the condition for an expansion and a bull market in equities. That's my position. But the behavioral and psychological action of the market now is displaying momentum based on a very powerful narrative. That's hard to beat because there is no data that can refute that narrative at this early stage. It's got to play itself out. It's got to tire itself out to the point where everyone is saying AI, including the cashier at the grocery store, saying something about, did AI help you choose your groceries today? When you start hearing that, then you can say, okay, I think we're at peak AI, but you can't stand in front of that narrative. And I think that's going to drive the market for a while, which will frustrate the short position. So, there just doesn't seem to be the return there that I would like. Now, maybe this whole thing will peter itself out in a couple of weeks and then it'll all be over. But I can't take the chance. I can't take the chance because I saw something like this back in '99, and it was disbelief after disbelief after disbelief that we just kept going in only one direction until you yourself got to the point where you bought into the fact that we can only go up, that we'll always just go up. That it's all over now. This is it. This is how we all make money. It always will just go up. It happens for such a long period of time that you simply just accept it. You cannot stand with a short position in front of that. That's a huge risk factor. But I'm not bullish. Bullish meaning that I believe that this is all justified by the fundamentals. I don't believe it is. If you think there'll be a melt-up bubble, have you considered short-term bull call spreads to get more beta? I have a rule. I have a number of rules. One of them is that if I don't believe something, I don't do it. So if we look at Bitcoin and crypto, never once did I buy into that story. Yeah, there was a lot of money to be made there. People made money, but I never once bought into it. I thought it was just ridiculous. I still think it's ridiculous. I think it's a big pile of nothing. Same with the NFTs, just a big pile of nothing. It's a casino, and there are people who look for a casino, and there you go. Speaking of casinos, I don't gamble either. I don't go to casinos. I know they're there. I know I could go sit and play blackjack or poker and maybe walk out the door with some money, but I just don't go. So this is something, because I don't believe in it, that doesn't mean I don't think the market can go up. It just means I don't believe it, so I'm not going to do it. We got 4 questions here. Assuming we accept the concept of lags, can you explain how the tightening process takes time to affect the indicators? For instance, Fed increases rates. Do banks increase their loan rates immediately? Yes, they do. Do companies then face higher interest rates within a week, a month? If they have floating rate debt, they face it on the very next interest payment. They face it right away. To the extent that they have fixed rate debt, they feel nothing. And to the extent that companies with floating rate debt do not have interest rate swaps or interest rate hedges in place, yes, they feel it immediately. And the next person walking in the door looking for a loan feels all of it right away. The marginal borrower feels it right away. These higher rates cause companies to invest less in 6 months. New investment would be curtailed, especially new investment that... let's say for a project that raised the cost of capital to the point that the net present value of that project was so close to zero or turned negative that it was no longer worth doing. So yeah, it does hit business investment. I've read that commercial real estate sector has been struggling significantly in the aftermath of the pandemic. If a credit crunch begins in this sector, will it be isolated or could it spread throughout the economy? I think in commercial real estate, let's pick out the sectors that are really troubled. Office and retail are the big victims there. There's lots of other types of commercial real estate that aren't affected to the extent, and I shouldn't say they're not affected. They're affected by higher interest costs. But not to the extent that office is. Office is facing, many office properties are facing an existential moment of whether or not they'll continue to exist or not. Will it be contained? That's a hard question to answer. I don't know that it will spill over into all the other commercial real estate sectors, especially ones that are doing, whose net operating incomes are doing just fine, whose vacancy rates are 1 or 2%, I think they'll do just fine. But it may impact other sectors other than commercial real estate that have high levels of debt. And they may have difficulty rolling over their debt. So there may be a debt factor contagion more so than a real estate factor contagion, if you know what I mean. If the housing market, which is considered long cycle, experiences a lag of 6 to 9 months, shouldn't the impact of interest rates be felt in less than 9 months in any short cycle business sector? Well, this is what I've been sort of getting at is that I think the economy is less interest rate sensitive today than it might have been 40 years ago. So I think that raising the interest rate at this point, I'm not sure has the same effect as it had in Volcker's time. Or in the 70s. Let's just look at housing. The last mortgage rate we saw from Freddie was about 6.6%. And the week before, mortgage applications were up. Yesterday we got the National Association of Home Builders Housing Activity Index came in at 55. Last month was 50, up 10%. So home builders are in expansion now. They were in contraction. It got all the way down to 42 and fought its way back up to 50 and is now at 55 and expanding. And we had housing starts today and building permits, 2 leading indicators. knocked it out of the park. Both of them came in wickedly strong. I mean, big numbers. And all the housing stocks were green and up today. Even though the market was red and down, they were green all the way through, unaffected. That shouldn't be, given where interest rates are. And if we believe the Fed, if data unfolds the way we expect with 2 more rate hikes, it shouldn't be. But here we are in an expansion in the most interest rate sensitive sector of the economy. So, do interest rates work? I don't know. I think they have some effect, but I think that a lot of that effect is dulled and muted by the financial sophistication we have in markets today, and probably by the sheer amount of wealth that households have relative to debt. Yes, there's a lot of debt, but when you look at U.S. Household wealth, just the generational pass of money from the generation leaving to the next generation is the largest in history. So that I think it's something like over 20% of houses are now being paid for straight out cash, no financing. You're going to need to get interest rates a lot higher if you want to affect the level of activity in the market. All of this, by the way, and housing starts and building permits, those big jumps, that's all employment that's coming up. That's all going to be employment and job creation. Right when the Fed really wants to try to put a lid on all of this. And we're seeing, based on the housing price index that we've seen over the last little while, they're going back up. Zillow index, housing index going up. Zillow rent index going up. If we look in Canada, the increase in rents almost 8%. And housing prices just going straight up. Bidding wars are now back. Well, this is part of core CPI. This housing makes up 32%. For PCE, it makes up about 16%. And the Fed was expecting base effects to wear this off, and now they're reaccelerating. I just don't think interest rates are anywhere near high enough to actually affect anything more than asset prices, because we haven't seen it actually affect consumer behavior. If you look at what the consumers are doing, if you look at job creation, if you look at wage gains, it hasn't really affected any of that stuff. It affected equity prices last year, but not now. We're in a bull market all over again, right? NASDAQ got to 9% below its all-time high, with interest rates at 5%, with money supply decreasing, with tightening credit. Conditions that were diametrically opposed to when it hit all-time highs were 9% below. Housing market expanding. Housing starts off the charts, and where's the interest rate effect? So I think, the Fed looking at all of this is looking at each other saying, we were worried about going another 25 basis points. We got to go another 200 before we even start to hit the neutral rate. At least I think that's where they're headed. Or I shouldn't say I think that's where they're headed. I think that if the data continues to play out the way it's playing out, that 200 basis points higher would seem like the place to go if we're trying to find where neutral is. What is your reasoning on the notion that ChatGPT needs to provide perfect answers to be successful? Well, I don't think I ever said it needs to provide perfect answers. In my opinion, these AI systems just need to be useful in order to make an impact. Yeah, they need to be useful. You don't need perfection to be useful, but you do need correction. I don't think that I have an expectation of a perfect answer. I think I have an expectation of a correct answer. That the output that I would get would be in the neighborhood of correct, not perfect. The first draft of my dissertation that I handed into the committee was correct, and I believed it was perfect. Well, I got corrected on the perfect part. It was not perfect from their eyes. With my eyes, it was bloody well perfect. But no, I don't think the output has to be perfect, but I think it has to be correct. Now, I ask it some questions sometimes. I read the answer. I go, yeah, that'll do. It's not perfect. I would have said some other things, or, from my point of view, I would have done it a bit differently. And then there are some things I look at and go, no, that's wrong. I can't even use that. So I can spend an hour and ask it better questions to try to get better answers, or I could just look the bloody thing up myself, right? So, no, I don't think it needs to be perfect. I think it needs to be correct, and it is getting there quickly. Now, this is Chat GPT, a very consumer-facing application right now. I'm sure that within companies there are verticals where they have a whole bunch of their own data and a model trained on their own data, and the output that they're getting is within the parameters that they need it to be, in a way that's faster than they could do it with a pattern, or picking up on nuances and patterns that they might not otherwise see without a lot of work. I'm sure in much more narrow vertical applications it's a lot better, but when you give it a very broad thing, like 100 or 200 or 300 million people asking it questions about almost anything and everything, yeah, that's going to be brutally hard to do. So that is not there, but a whole bunch of all these little vertical things I'm absolutely sure are there. So I'm not saying that this is a fad. It's not. It's going to be something. But in the late 90s, when I was using the internet, I said the same thing. This is not a fad. It's going to be something. But, I mean, I was underwhelmed for a little while. You go online and say, is this it? I mean, is this really it? Is this all you can do? It just didn't seem like it had all the promise. You had stories of everything it was going to do, and when you went online, you said, it's not doing any of these things that it's supposed to do. You can't do this, you can't do that. But it did. In time, all of those promises were delivered. I'm not going to read through this stuff here, but you do provide some answers to the fundamental issues here. Let's see. Start studying November level 2. In regards to the index earnings Excel sheet, what's the difference between operating earnings and reported earnings? Operating earnings are just that. It is EBIT, earnings before interest and taxes. As reported includes, sorry, I shouldn't say it's before interest and taxes. It's earnings from operations. Let's just leave it at that. Earnings from operations without any of the stuff that happens after that line on the income statement. Whether it be because of charges for discontinued operations or things like that are non-operational. They're included in the as reported number, but operating earnings is just what they earn from operating their business. How do you keep track of changes in forward earnings? I'm trying to find a more efficient way other than just making notes whenever Silverblatt makes adjustments to Excel every 2 weeks. In his columns, in the columns on sheet 1, he does provide where the estimate was 6 months ago, 3 months ago, and then where the current one is. I think it goes all the way back to the last 4, 5 or 6 quarters. He does provide estimates of where it was, so I just use those. And I think I have all the spreadsheets week after week, so if I got to go back and look at something, I can. Somebody is entering my door and trying to do it very, very carefully, so go ahead, just close the door. There you go. There you go. All right. Let's see. Thanks for the great content. I can add my own 2 cents on the AI. I've been long interested in the progress over the last 2 decades. Has been very slow, just incremental. But then 2 revolutions happened over the last year almost at the same time. The first one is the generative AI, and the other bigger, in my view, is ChatGPT. Generative AI seems to be something that multiple entities were able to achieve very good results at. It is a revolutionary technology, but I don't see it changing the world in a really transformative way. Okay. Then we've got ChatGPT. This is a weird one because it offers something that seemed decades away just a year ago, even though it's not perfect. It's got all the problems you're talking about, but at the same time, it has the knowledge and ability to apply logic that in many, if not most cases, exceeds an intelligent human. You and I are going to have to define what intelligent human means, because we may have a different idea of what an intelligent human is. I used to be a high-level software engineer, and I'm really astonished at its logical abilities, especially when working on assumptions given in plain English, despite some teething problems. What it does should not be possible. Second strange thing about it is that nobody else seems to be able to get to that level. Google's tools look like a joke when put next to ChatGPT. So it's just ChatGPT at the moment. So my best guess is they have achieved some kind of breakthrough that others can't successfully use. And the abilities that it shows from my point of view are so extraordinary that most likely they will change the world massively, and possibly, unlike internet, it could happen very quickly. Well, the internet happened very quickly. This technology is doing amazing things already. Yeah, I do recognize this, as I said in my previous videos. I do recognize this as something, as a transformative technology. Much as when I looked at the internet, I saw it, and I said, this will be a thing. And I looked at crypto and I said, this is not going to be a thing, right? All right, wondering your thoughts on Apple not hopping on the AI bandwagon. An example, in the recent developer conference, they did not say AI or artificial intelligence once. I'm going to have a sip of water here. Yeah, I've noticed that they have not done that. It could be that they don't need to do that, just because of their hardware ecosystem that they have, and just because of the product base that they have. They may not need to. But, I mean, they haven't done it yet. And I think, Jobs a long time ago said, you don't have to be first, you just have to be best. That take your time, make it right, make it good, and then release it. You don't have to be first. So they may have that in their DNA, saying, okay, well, everyone's saying it right now. Let's just keep our head down. Let's just do our thing. We don't know that they're not doing it, but they may then, in 6 months from now, come out with something that now, that's the standard now. I mean, just because they're not saying they're doing it doesn't mean they're not doing it. It could be that, given that their stock price is, hitting 52-week highs, or it has been for a while, maybe they felt, well, we don't need the boost. Let this run itself out first, and then, to get us to the next level, then we'll use it when we need it. I don't know, maybe. For them not to have their toes in this pool somehow internally would be shocking to me, given the sheer amount of data they know about everybody, given what they know about me. It's unbelievable, because all my devices, I've got 5 of these 27-inch Macs around the house, 2 iPads, an iPhone, Apple TV. They know everything. I got 2 Apple TV devices on 2 TVs, plus a subscription Apple TV. I mean, I'm deep in their system. They know a whole bunch of stuff about me. They know what I watch, when I watch it, when I stop watching a show, what kind of shows I like, what kind of shows I hate. I mean, they pretty much have so much information about me that they could probably predict when I'm going to upgrade, what I'm going to buy, what store I'd probably buy it in based on where I bought things in the past. That they are not using it would be shocking to me. That they are not announcing it, yeah, they've sort of done that in the past. They've never been first. I mean, BlackBerry had the market for a while, and then they released their phone when they were ready. So they haven't been talking about it. Doesn't mean they haven't been working on it, right? Let's see. My understanding is that you can either buy in the money options or create a synthetic long position instead of going long a stock. Yep, you can. When would you pick one over the other, and why? Capital would probably be the obvious thing. If you're buying in the money calls, all you have to put out is what you're paying for in the money calls. If you're using a synthetic, since you got one option that's going to be a short position, well, you're going to have to put up some capital for it. It could also be whether or not you want money in or money out. If you're buying an in-the-money call, money leaves your account, but you can create a synthetic at any strike price. So as an example, let's take a stock. Let's say it looks like this, and you think that it represents a good buy because you think, well, you wouldn't buy it if you didn't think that. You think it's going up. You can create a synthetic, or you can go down here and you can buy a call, right? And if you buy the call, you're going to pay at least this much plus some kind of time value, but the time value will be, as a percentage of what you're paying out, will be low. The more in the money you go, it's not that the less time value you pay, it's that as a percentage of what you're paying, it'll be lower. And you'll get a high delta. You can get a delta of greater than like 0.75 or higher. And as it goes up, your delta increases. It's kind of like having the stock. But you'll pay whatever this is. You will pay money for it, but you're limited to this. So if it decided to go down, that's the most that you would lose there. You could also do a synthetic, and you could use a strike price up here. And you can say, well, my target price in a year is 30% higher. And if this is $100, you can go out a year and you could look at the 130 strikes, and you could sell a put. Negative put, buy a call, and the put would give you at least that much that you receive in terms of money coming into your account. So you could just buy a synthetic with this much, with that strike price out 1 year, and as the stock rises, the value of the premium on the put decreases. It's the same as buying the call. You're making the same distance of money. I think you get a higher ROI over here, but it does require cash to leave your account, whereas here you'd probably get a lower ROI, but you're going to get a credit. Money is going to come into your account. It's it depends on how you feel and which way you want to go. Buying the call, an in-the-money call, also allows you to do some other strategies as well, right? So if you're buying that call, what you can do is you can sell a put lower than that to help pay for this call. You can also do what's called a poor man's covered call. So you bought the call, and you can sell calls up here. So if the stock is here, you can start selling calls up here. Because you're long, you can always call away the stock if this gets called away from you. So you can do a poor man's covered call on that as well. Do you think consumer staples would be an interesting sector to invest in an uncertain environment like we have these days? Consumer staples, I think, is always a nice, safe place to be. Overall, nice, safe place. It doesn't have a lot of volatility. I think it trades in between $67 and $77. So it's nice to work the options on that as well. Higher dividend yield than I think some of the other sectors. It does have a fairly good dividend yield. Do you consider energy stocks a good investment theme for the next years? Yes, I do. After COVID, they had an impressive performance, but lagging year to date. Seems to me that we remain a supply-constrained market for some time. Yes, it will remain supply-constrained for some time because there is going to be no new investment. So all that CapEx is now free cash flow. If you look at the free cash flow yields of oil companies, they're huge. They're absolutely huge because that is no longer going in to replacing reserves. So if you pump 1 million barrels out of the ground, typically you'd want to replace that million with proven reserves somewhere. Well, that costs money to find. Well, if you don't have to do that anymore, which most oil companies are saying, why the hell should we ever try to explore for new fields? I'll tell you what, if we hit new oil in what we're doing now, okay, fine. If we hit a well and then we drill down another 1,000 feet and we hit another reservoir, great. But we're certainly not wildcatting anymore. Those days are gone. The cash flow yield is huge. Well, at some point, all of that has to be returned to shareholders. At some point, it all has to. So expect increasing dividends and increasing stock buybacks on a go-forward basis. So even though their revenues might not be growing, like they did in the past. Their revenues may grow for the next 3 or 4 years and then go flat for a while. It's the free cash flow that they're spitting off. In some cases, 14-15% free cash flow yields. And all of that's got to be returned to shareholders some way because it's the shareholders' money, right? So that's the play on energy stocks right now. And I'm not going to do my own research on this. Buffett likes Oxy. I'm sure he's done his research. I like Oxy. So I'm good there. I believe you must be very busy with all the stuff you do for us, and thank you. I want to ask if you still plan on posting the rich don't pay taxes rich don't pay taxes, tax the rich video. Rich pay taxes. I'm trying to think. At some point, I want to get to videos to some of these things, but I think I need a different format other than a screen with me talking behind the screen. I think it requires a different format because these are discussion based, and if I'm going to take a position like that, I do think that I should have, it should be a conversation with someone who's diametrically opposed to that, who simply doesn't believe me, so that it becomes more of a chess match instead of me just saying blah, blah, blah. So I need to think that through a bit, but I don't think that it would do well with just me behind some words on a screen, right? I'm a week after closing my short position. I keep worrying now that things will crash and I'll just be sitting here watching. I have the impression that once I find other ideas, I'll stop caring. How do you come up with and develop novel investment ideas? Have you got a process for generation of ideas? From a top-down perspective, you can see a lot. And then sometimes it's listening to other people. Some people will have ideas that, in a sector where you think, hey, that fits with my top down. That fits nicely. I never thought of that, and thank you for that. Or somebody will recommend something, and I can never know if I like something when I first hear it. I have to look at it for a while, and then I make a decision. So yeah, it's just a matter of keeping your ears open. You can't know everything. Sometimes you hear somebody say something and you think, okay, well, let me look into that a little bit further. Let me see if it fits with what I believe. And that's all. Have you got a process? I'm also enjoying the wheat and hog cattle spread trades. Hog and cattle today just killed. Front month hogs hit a 6-month high, 2-year high, or something like that. It hit a high, and cattle pull back. They both legs worked out. The spread decreased because both legs decreased. It was beautiful today. The December spread is still 100 points away, 100 points. I think that I would close that position once it got to 70. Once the spread narrowed to 70 points, I wouldn't wait to 50, but at 70 I think I would close it. But I think we're down to 100 points today. Do you manage your portfolio all by yourself, or do you have assistants who help you compile data? I have external managers, so let's draw a circle here. If that is the sum of my wealth, I have external managers for this much, and I invest this much, which is still quite significant, and I am still underinvested. But this has no choice but to be long only. So this has been participating in the rally while I have been short. Actually, it's probably more like this. Let's just clear it off and make it look more like a third. It's more like that. What's your 3 to 5 year outlook on the Canadian economy? Troubled. Also, what are your views on Canada accepting record immigrants year after year? I have no issue with that. I mean, I don't care about that. I care if there is just a social burden and a social cost. Like if we're accepting immigrants and primarily just refugee immigrants where they're going to be on the system for a year or 2 years, and every Canadian's going to have to pony up to pay for that. Not that I have an issue with that per se, but that we already have enough significant problems of our own, really, without redirecting money from people who have been here, who really need help, to people who aren't even here yet, and handing them up to $40,000 a year in social services, because that is what we do. I do have a problem with that. Um, I'm indifferent, really. I mean, I don't think about it. I think being that Canada, the Canadian household has much more exposure to interest rate hikes because of just the sheer amount of floating rate debt and the nature of the mortgage market in Canada, that you have to go back to the bank every 5 years and sing for your supper and renew your mortgage. Yeah, I think that's going to weigh heavily as we continue going forward. But yeah, I think we will probably over the next 3 to 5 years easily underperform the U.S. Yeah, Canada is a big country with a lot of space. However, much of that space is not usable. So if we think about the U.S., and I'll just draw the U.S. out in kind of a minor way here, it's kind of just shaped like, there's the U.S., and Canada kind of expands like that and then has a whole bunch of islands and stuff up here like this. There's James Bay. Here are the Great Lakes. They're more like here. There, that's my best view. 80% of Canadians live here, right? They live pretty much at the border. That the further north you go, the more the distance you have to cover becomes expensive. It gets cold in the winter. It gets much more difficult to get further north in the winter. Further north you go, many of those places are fly-in only. And even in Ontario, as you head north, you think, well, there's lots of space. Some small towns just build more. You can't, because the bedrock comes right out of the ground. It's the Precambrian shield. And you can't build basements in bedrock. So there's only so many places where you can build a new development, and that's it. So if you go up to places like Timmins and you want to build a new house, there's not too many places where, even a new development, not too many places where you can get that done. This would be just because of the nature of the bedrock. So you pretty much have to buy existing homes, tear them down, and build new homes. That's why Timmins' population has been static for a long period of time. So most of the population is that close to the border. The rush of immigrants coming in, or the amount of immigrants coming in, typically go to a few centers. You've got Montreal, you've got Toronto, you've got Vancouver. Those are the three big areas that they tend to head into, because there's large communities of expats, of their own expats there. So they have a support group in that respect. But they're almost unlivable cities in terms of what it costs to live there. But where do you go? It's again, we have a big country, but we don't actually have that much space really for development. That may be different once you get out into the prairie provinces. I don't know, but as you go north in Quebec and Ontario, it's not friendly for building. I'm having a hard time with this market. I got put the MES 4,000 call. Now I'm short MES contract of 4,000. At 4,000, less what you sold it for. You sold the call for something, so it's you're short at maybe 4,100. Should I close it, take the loss, and sell some calls? And I'm not going to give you advice on what to do here. If you're uncomfortable with what you have, my strongest suggestion is don't do it or get rid of it. If you need me to walk you out of it, that's something I really don't want the responsibility of doing. You should only be doing things you feel comfortable with. And if you had the 4,000 call, it had a certain delta. To allow that delta to get this far out of control, you weren't, in the applied series, I do have a video that shows you how to continually rebalance your exposure so that it never gets this far. And to let it get this far is, well, you should have been doing risk management before that, right? Partially, based on how the market is acting, I'm forced to give up on this trade. Yeah, you want my thoughts on that? I can only tell you what I think and what I do. And, I've said a few times too that I'm telling you what I do and the process that I go through. In no way is this meant to be, here's what you should do. I'm not trying to manage anybody's account here. But if you are taking a position, risk management up front all the time. If you're uncomfortable with what you got, then get rid of it. The sooner you get rid of it, the sooner you'll feel better. Yeah, it's going to suck taking a hit, but no one in this industry has a 100% track record. No one has a 100% track record. Everyone, including the best, take losses, and even the best every year still have their losses that they have to take. No one, I think, has a perfect year where everything they did worked out. And if they do have a perfect year, it's probably because they only made 2 or 3 trades or 2 or 3 investments, and that was it. They went way too conservative. So I cannot understand the market currently, and I find the valuation absolutely ridiculous. The valuation on some parts, yeah. Has to be a Louvre exhibit for Mark's artwork. Yeah. I would like to ask when you start managing the risk on short calls on ES futures. What is your criteria that now is the time to sell puts? Well, you reduce your exposure. You find positive delta wherever you can. If that's not enough, then you have to at some point say this is not the market that I need right now to be short. I need a market that the narrative in the market matches the macro backdrop. And right now, the narrative in the market does not match the macro backdrop, so I don't have the market I need to be short. In which case, it doesn't make a lot of sense. It is clear that AI is fueling the recent rally in a tight group of tech stocks. However, I'm noticing that XLY is taking off too. XLY stocks usually precede an incipient new economic upcycle. Is this perhaps an indication for a softer, even a no-landing scenario? Well, here's the thing. I don't believe so, but I'm not the market. If enough people believe that's the case, then this market goes higher. That does not mean the economy gets better, by the way. It just means the market goes higher. At some point, unless the economy goes along with the market's going to have to correct back down. But until then, because it could take 2-3 quarters before we get evidence of the economy catching up or evidence that the economy is not catching up, well, I can't be short for another 2-3 quarters. So it's, what can you do? Are you familiar with Russell Napier's ideas on financial repression? Yeah, I am. He argues that at some point down the road, ever-growing deficits and unrestrained fiscal policy will drive the Congress to force the Fed to monetize the debt, at which point the U.S. and inflation will break for good. I don't know. I don't think so. Whenever you start projecting things like this, it's usually linear projections from where we are, and I don't know that's very helpful because so many things can change. For example, if you get a massive productivity boom in the U.S., you could have periods of 4 to 5% real GDP growth for a number of years. Well, as long as your GDP is growing faster than your debt to GDP ratio is decreasing. Also, the amount of debt, the one thing that I think could happen very quickly, and I don't know why it doesn't, is the Fed wants to reduce its balance sheet and the Treasury wants to reduce its debt. Why not just cancel the Fed debt? The Fed is holding, 7.6 trillion of Treasury debt from QE, and every time it rolls off, the Treasury pays the Fed returns that money to the Treasury. Well, actually, right now it's sort of just moves some zeros over and cancels it. It shrinks the money supply, but just cancel it. I mean, it's the Fed paying it's the government paying another body of the government. It's paying itself. So just cancel it. They could do that. There's $7.6 trillion gone off the debt, just like that. So they could do that. But these kind of forecasts that look out 10 years and forecast linearly, without considering all the different things that could happen that could change that scenario. Yeah. And I think that the country that has the best prospects of getting that done is the U.S., because it is the most entrepreneurial country on the planet. So as long as it continues to do that, and they don't decide to start regulating capital and taxing capital at the same rate as labor, they'll continue to be the most entrepreneurial country on earth. How was the economic environment during the dot-com? Was the Fed policy QE or QT? There really wasn't any of that stuff going on at the time. I think you had, I'm trying to remember the best I can, but I don't quite remember. I know everybody who wanted a job was working. That I know. Anybody, you could find a job anywhere, and especially in IT. If you were in IT and you didn't have a job, it's because you had some kind of murderous streak to you that everyone recognized, and they didn't want you in their place. But I just remember that everyone had a job. If you wanted a job, money was everywhere. As far as what the economic environment was, I don't think that at that point I was really that macro sensitive. My concern regarding the AI data set is a bit different, but maybe we mean the same thing. If AI is only capable of generating an output based on an immense data set, and that this is the technology everyone will incorporate within their work with the future, who will create the initial data set? Well, the data set's already out there based on the amount of information that already exists in whatever domain. Right? In whatever domain, even these narrow verticals might have a whole bunch of their own data, whether it be a supply chain, whether it be a production line, whether it be inventory data. It already exists out there. If it remains a reiterating process. Well, this is sort of my thought, is that if the output becomes the data set for the input, wouldn't it over time, narrow down the possibilities and filter out any variability in the data set, such that it's now training itself or developing itself on its own output, right? I mean, if we are using its output in that sense. I don't know enough about it to really make an assessment, but if you're thinking like an analyst, the first thing you do as an analyst is you list all the questions you have, right? And then you got to go looking for the answers for all those questions. So when you come across a company and you see certain numbers, ask why. Why is it this way? Why is it that way? Write down all your questions. These are the questions I have. And then you go searching for your answers. So right now I have these questions. That doesn't mean that there is no answer for those questions, or that there exists an answer such that my question goes away. It's like, oh, that's how you deal with that problem, and oh, that's how you deal with this problem. But you got to have the questions first, and those are my questions. And any good analyst would look at something and you write down all the questions you have. I don't understand how this works, or how did you get this, or what happens under this scenario, or how does this unfold in this particular way? And some people have given me answers on this. I have it's a long one. Question not specific to the week's market outlook. What is the best way to interpret and consume what all those experts and pundits argue on Bloomberg or CNBC or any other media channel? Well, yeah, that's the problem, is the media. You have some people on there that talk their book. You have long-only portfolio managers that are on there that, surprise, are bullish. So it's, sometimes it's difficult to know who to listen to. I don't think any of them are really worth listening to. I think it's worth coming up with your own opinions first and then listening to the opinions of others, especially the opinions of others who are saying something that you don't agree with. So that you can at least be aware of maybe some blind spots you have, or can you refute each of their points point by point. My question is not about who is smarter or whom should I follow. My question is about each individual's unspoken intent behind whichever narrative they present, be they may bullish or bearish or pursuing particular industries or stocks. For example, here's one thing I noticed. Have you ever heard a CEO go on the air and be bearish about their company? Right? That can't possibly be true. That every company is got all this great potential in front of it, but the CEO is the last person to ask, "How's your company doing?" "Oh, we're doing fantastic. We've got so much going for us, and the people. Oh, let me just tell you about the people we have. The best people in the world. Like just such a great team that we work. They got to say all that stuff, right? And this is going on, and we partner with our customers, and we do, and blah 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 blah. And you know exactly what they're going to say. For example, if a guest speaker represents a particular asset management firm, their motive to come on air must be client solicitation or awareness. A lot of times it's awareness. Whatever analysis and interpretation they present and discuss on TV is to convince the public that they are smart and should be given more business. Sometimes, yeah, I think that there is some self-serving bias in there. But people generally, do want to give, they will answer questions honestly. So when they're talking, I believe they honestly believe that, but they believe it for particular reasons, right? What about the bulge bracket banks, say JP Morgan or Morgan Stanley or Goldman Sachs, and their head of research or chief strategist or whatever? I'm aware that their reason to exist is likewise sales and marketing function for the firm, not the provision of education of the public. Then should I always presume that those big hats from big houses come out on TV day in and day out to push certain narratives in lieu of pump and dump or rogue? Well, listen, I think what you're getting at here is you're asking, who should I listen to? You should listen to yourself. Rather than turning on the TV saying, should I listen to this person? Should I listen to that person? They're telling me to buy this. Or should I listen to Kramer? He's telling me to buy everything. You must develop yourself. You must develop your own experience, your own education, and your own skills, and you're not listening to these people any longer for what they have to say in terms of buy this or sell that. That's not what you're listening for. You're listening for maybe that sentence where you think, oh, I never considered that. When I listen to ones that come on, most of what they say I've already considered. I'll be listening and go, okay, I've already considered that. I've already read that. I'm aware of this. I'm aware of that. I'm aware of that data point. I'm aware of this. I'm aware of that trend. But then they might say something where I go, I'm not aware of that. Now, I won't take their word for it, but now I know that I'm going to look something up because I wasn't aware of something before. So I don't know that you should outsource your asset allocation decisions to voices on CNBC or on Bloomberg. And I think more so on CNBC, they have this regular stable of guests that they have on, and all of them have something going on. All of them, I think, run a podcast or run another, a YouTube channel, or they do something more. To generate revenue off of their name, off their cachet that is on the air. So they're on the air to be on the air, right? Which is another animal altogether. They are on the air to be on the air. So I think we can go past this. Q's hit that April 22nd resistance on Thursday, Friday. I think that's an important hurdle to clear before the last important high, before those all-time highs. Do you think this could still be a prolonged bear market rally and we go lower from here? Yes, there is the AI narrative, but the Nasdaq in 99 was also making consistently higher highs. Really didn't do much till the second half, especially the last quarter. the fourth quarter just exploded. IPO after IPO after IPO, 2-3 a day, every single day. IPO. That's all there was. Positioning was bearish, and then sentiment flipped bullish very quickly. You don't think a lot of this is down to some very lopsided positioning and improving liquidity from SVB situation finding its way into risk? No. I don't think, I've heard that argument that it was the provision of liquidity, the Fed's balance sheet went up. Yeah, and it came right back down. Okay, it went up and it came right back down. So it didn't do all of this. I don't think it did all of this. And let's keep in mind that while that was happening, while it came right back down, the SOMA, which is the open market operations part of the balance sheet, was running off as well and will continue to run off. So yeah, it ran up, but it ran right back down again. So no, I don't think that's what it was. How'd you come up with the percentage change for operating earnings estimates? I looked at December 31st, what the forward 4-quarter earnings was. Then I looked at what the forward 4-quarter earnings are now. That's all, and just took the difference. Just a note, I would argue that the bond market leads the Fed. I agree. Rising levels of inversion have continued last week, but is approaching the levels of October 22, suggesting more Fed hikes ahead. Better to follow the bond market than the Fed. Big test of October levels underway very soon, it seems. Yeah. I think the bond market, and I've said this before, I think the bond market is the smart market. It seems to have it right. I think the bond market is pretty good. I think the interest rate futures market had it wrong. All last year and even into this year, the interest rate futures market had it wrong. They're just starting to get it right now. What are your thoughts on inflation figures being shown on Trueflation? I don't know what that means. Trueflation, I'd have to Google that. UK figures, well, UK, if that's a term that's being used to describe something in the UK market, I wouldn't be aware of it because I don't follow the UK market. Curious to hear your take on Mike Wilson from Morgan Stanley, his thoughts on equity valuations. I have been seeing him on Bloomberg TV and his views seem to align with yours. Also, why use the S&P 4-quarter earnings forecast on the Bloomberg's, which is an aggregate on analyst estimates? So is the S&P 4-quarter earnings forecast. Is it because S&P value is more accessible? It is more accessible, yeah. To the retail investor, yeah, but it is an aggregate of analysts' bottom-up estimates. I'm sure they're not the only ones which have it, but it is an aggregate of analyst estimates. Morgan Stanley, Mike Wilson. Well, I agree with him to some degree. I think, when I listen to him, I think, okay, well, I've thought of all those things. I agree with that. I don't know so much that I agree with the decreases in revenues because inflation is coming down. Inflation is still prices going up, just going up at a slower rate. So even though inflation go from, let's say core goes from 5.3% to 4.3%, that means prices are still up 4.3%. They're still up. And with job creation still being positive, that means more people are working. And with most North Americans, if you want to increase spending, simply just put money in people's pockets. There's no question of how much they're going to save. They will spend it. The propensity to spend is off the charts in North America. So I think that revenues can still continue to grow as long as you have employment continuing to grow. Each household may spend marginally less, but you have more households spending money. And the thing with prices coming down is more people, or I shouldn't say more people, but people will just buy more stuff. So if they had $1,000 and they could buy 10 units of something and prices drop, they'll buy 11 units. They won't just buy 10 units and save the difference. They'll just buy more stuff. They'll just buy more stuff. So I don't agree with the idea or his thesis that as inflation starts to come down, this will affect company revenues. I think as inflation comes down, it will give a boost to company quantities because they'll just spend more stuff. They'll just buy more stuff. So that's the one part I'm not quite with him on at that point. Bose Weinstein recently did an interview with Bloomberg where he spoke about how a quarter closed-end funds are trading at a discount to NAV. He stated that if these funds transition to open-end funds, there could be $60 billion in unlocked value. So wondering if you had seen this interview and how retail investors, how can retail investors best participate in closed-end funds? Well, you simply just buy shares. Closed-end funds, there's shares traded on the market, and that's it. So they can trade above or below their net asset value. Open-ended if it's publicly traded as a fund, there's a creation and a redemption process that keeps it very close to NAV. Mutual funds are typically what you call an open-ended fund, where you buy and redeem at net asset value at the end of the day. You just don't have prices in the middle of the day. The closed-end fund trades on the market, so you have price discovery all day long, but it can get out of alignment with net asset value because there's only a limited number of shares. I don't know. I mean, he's in a very narrow perspective here in what he's looking at. It's nothing that I would be zooming in on saying, okay, well, let's buy enough of this stuff and then force a change to closed end to unlock this value. I don't know that, I don't know that that's something that I would do. Wouldn't it make sense to adjust the historic valuation of the S&P 500 to the sector mix in the economy? Let's say earnings in economy have a 50% weighting in software. I see what you're getting at, is that being that the S&P has a more growthy elements to it than maybe it had 20 years ago, that you can't use the same multiple, but you can use a 5-year or a 10-year average forward multiple, and we are above those. So you don't, even if you use an average of the 5-year, over the past 5 years, you'd say, well, the weighting towards growthiness is probably, fairly constant over the last 5 years. I mean, once you go back over the last 50 years, maybe, you might have an issue. But you could argue that, well, no, there was growth 50 years ago. It's just that they were in, manufacturing sectors. They grew. They were the growth stocks at that point in time. So if we're going to adjust for growth, you have to then readjust the value stocks for what they would have been then, right? So if you look at industrials and say, well, 8 times earnings, but in the 70s they were 17 or 16 or 15 because they were the growth stocks of the economy, then you'd have to readjust the lower ones higher as well if you want to do that. So that kind of adjusting becomes very difficult to do. It's easier just to look at the earnings that can be generated by the 500 largest companies and the growth rate in those earnings, and then look at the PE in light of the growth rate. So if you have a growth rate, a real growth rate of 4 or 5%, you may be able to say, well, upwards of 20, 21 times forward earnings, maybe. But when you have a real growth rate of 1.1%, then it's, kind of hard to justify. So let's take earnings, let's say you have an earnings growth of 10% year over year. You may say, okay, well, we should trade maybe at the upper end of the multiple because of 10%. But what if you have zero earnings growth? Are you going to start saying, I'll pay more for that? No, I'll pay more for it. No, I'll pay more for it. 0%, I'll pay even more for it. Now, what if it's negative? Because that's what we have right now, is negative, slightly negative. But the market has decided, no, 17 and a half is not enough. I'll pay 18. 18, let's go to 19. 19, 19, I hear 19.5, 19.5, 20. 12, sold. 20 times forward earnings over there. All we've had this year is multiple expansion. So it would not matter what the mix of companies are when you bring it down to the fundamentals those companies can produce versus the growth rate in those earnings. And there you don't have to adjust anything. I understand you're willing to own TLT if they're being put to you. However, if they are, it requires a lot of capital. Yeah, wouldn't it be more efficient to get that exposure through futures in that case? Yeah, I guess you could use ZB to get that, but if you're long ZB, especially at these high interest rates, you have negative carry. With TLT, you're not going to have the negative carry. You have positive carry in the sense that you get a dividend in, but you could always flip it out for a synthetic. If it is put to you, you can take a 1 year synthetic and move it into that. Why not sell calls on TLT as well? Yeah, those are all options. I mean, if I own TLT and I think it's under pressure for a while, I'll sell calls. I got no problem with that. I'll create cover calls on that. There's still, some premium month to month on it, along with the dividend that you can get on that. I can create you have the calls every month that you can sell if you're not going to be greedy and only go for 50 cents on the calls. You can generate $6 a year along with their dividend. You can get a 10-year. You can get the equivalent of a high yield bond owning TLT using the options. You're quick to judge AI, but have you tried the AI generated relish? No, I have not. Something I'm curious about, do you think we've disconnected from fundamental value since the pandemic? Well, yeah, I think on both sides we disconnected. The market became very connected to the sheer amount of money that was being pushed into the system. And it became very connected to that. We have the absolute opposite going on right now, and we're threatening in about another, if we continue on in another month, to make all-time new highs. Perhaps the amount of liquidity via QE and stimulus has brought the market down a new path, and if the Fed is trying to steer us back to the original path. We just haven't made it back yet, and still in no man's land of sentiment-driven liquidity. Indeed, I wonder if... Oh, there is a read more. Well, I don't need to read the rest to know where this is going. I think you're right. I think that the market right now is sort of tied to, the last 2 years, thinking that this hike in rates that we're getting right now is the temporary move, and then we're just going to go back home to the zero line. So they're anchoring to 0%. And Powell had made it clear years ago that 0% was the temporary. That was the deviation. Now we're going home. And most people think, no, zero is home, and we're just out in the wilderness right now. But at some point, Powell will bring us back home. Powell has brought us home. And for him, I think home is maybe 100, 150 basis points lower than here in the long run. But the zero line is gone, and I think home for him is a balance sheet under $1 trillion, not 8 point something trillion. Regarding your scenario with high inflation and economic collapse, you suggested the Fed may not do rate hikes or cuts, essentially be inactive. It seems like the Fed would come under such crushing pressure to do something that action would have to be taken. In that scenario, do you think the Fed would prioritize employment or inflation? Yeah, so, this is kind of funny, is that there still is the fiscal side, and in a situation like this, you could see the fiscal spending all of their energy trying to get the Fed to do something when the fiscal could just do something themselves. That's interesting. Would they prioritize the economy or inflation? If you had the economy hit a hard landing and inflation did not come down, I think there would have to be a re-evaluation of what the hell is causing inflation at that point, because the traditional models would have to go out the window. And if there is still inflation, Yeah, that's going to have to, you're going to have to bring in the forensic accountants at that point and say, what the hell is going on? Where's it coming from? Um, because if we don't get rid of it, it becomes entrenched. And especially in a recession, if you do have a recession and inflation stays there, all expectations will ratchet up to that level of inflation, which will be the new expectation. And that is brutally hard to get rid of once it gets there. So I think they would prioritize inflation. I'm also curious your advice on creating rules for selling positions. I'm long only due to my job, and I've been long Nvidia since October. I'm waffling between wanting to hold on because of the incredible growth and selling because everything tells me it's overbought. Bulls make money, bears make money, but pigs get slaughtered. I see greed in that sentence. Oh, it can go higher, it can go higher. I don't want to sell it now. Yeah, listen, you'll never pick a top and you'll never pick a bottom. You have to pick a return that you say, hey, that's pretty good. Who's your favorite bestie on the All In Pod? My least favorite is Chamath, because sometimes he's just rude to his own friends. Like one time he said to somebody, I can't tell if you're naive or just stupid, and I think he meant it. And I mean, there are times I disagree with friends of mine, but I could never bring myself to be so cruel and insulting to a friend. So I think he showed a little bit of who he is there. I don't like that. Sachs, I think, is level-headed, but sometimes goes off into the right part of conspiracy theory, sometimes a little too much, and it's like, okay, well, a little too much there. I don't know all the names. The moderator I like, and the science one I like. They seem to be very level-headed. I like both of them. What is it that you like about Deer and Cat? Their balance sheets, their income statements, their earnings, their guidance. What's not to like? Both of them knocked it out of the park on earnings and raised guidance. Both of them. So what's not to like? I've been noting Bloomberg framing and concentration the past several months, and it's become quite apparent that it's a positive news skewed bias. Why? Well, because the markets are going up. The preoccupation with headline PCE, CPI for the better part of 6 months and almost completely ignoring core. Yeah, that really bothered me last week when every time they talked about inflation, they just pointed out headline. Oh, inflation is down to this. The run rate is 2.1%. And every guest they had on talked about how low it was. It's going away. And it's like, am I going out of my mind? I looked at it and I looked at core and it hadn't budged at all. And I'm thinking, but people, core, isn't anybody gonna mention core? Isn't anybody gonna mention core? And then it was later in the week, I was watching Wall Street Week, and it was Romaine Bostick who was hosting it this time, and he said something about inflation or this or that, and the Fed's data dependent, and one of the guests said, well, you're looking at the wrong data. You should be looking at core. And it's like, oh, well, thank God finally somebody said something, because I was going out of my mind on that. They love to talk about upswings in the S&P 500 because that's the news. It's so shocking, right? I don't know that they're cheerleaders for the market as much as, can you believe this market? It just keeps going up. To not talk about it would be suspect, I think. But downswings are just a side point snuck in at the end of the show. To what degree do you believe this influences markets or is a representation of general market tendencies? I don't know. That's a good question, actually. To what degree does this stuff actually affect people? Being that a lot of the live trading pits are gone, I think that almost every trading floor somewhere, or every retail trader sitting somewhere, has either CNBC or Bloomberg on. I think it has to infect their thinking. I think it has to. Either way, that's one in the minus column on actually being interested in truth. I don't know that I would say it's that they're interested in truth as much as what the hell is going on. And if the market is going up and it's going up and it's going up, and they're talking about the market going up every day and going up and going up, after a while it infects them. that suddenly the narrative begins to change that maybe we are in a bull market. Like if you were around something 8, 9, 10 hours a day, every day, after a couple of weeks, you start to think that way yourself. So maybe they're just so close to it all the time, and they see it going in one direction all the time, that no matter what the economic data is, no matter what comes out now, you can interpret it both bullish and bearish. So if the market's going up and going up and going up and we're in a bull market, all the data that's coming out can be seen as bullish no matter what it says, right? Do we start to consider the risk of entrenched inflation significantly elevated? FOMC seems to be preoccupied with things breaking so much that they're signaling that they're willing not to go too far. For all of this, we're going to see that tomorrow. Powell, 10 o'clock, is on Capitol Hill being grilled by Congress. Lastly, are you rolling up your ZW puts? Not yet. I'll see. I'll see how things unfold, but no, not yet. Let's talk about food. What's your favorite to take away? Oh, takeout? Takeaway? I don't really do that. I pretty much eat at home. What do you like to cook yourself? I don't know that I have anything in particular. Pasta man? No, I'm not. Simple and relies on quality ingredients rather than quantity. Don't mind hearty. That's not much of a question here. I don't really have a thing. Egg whites in the morning, really. Lunch is, I don't know. I'm not a foodie, so I couldn't answer that. I generally agree that there's somewhat of a bubble formation with AI. However, I believe in the bubble triangle framework provided by Turner and Quinn in their book Boom and Bust. Bubble triangle requires marketability. We have that. Money and credit and speculation. You got speculation. Marketability meaning, I guess, a good narrative, a good story. You've got that. You've got a healthy dose of speculation. Money and credit. All this sparked by either government intervention or new technology. In my opinion, we have all these features except the money credit part. I don't know so much that we need, with so much wealth hanging around, money finds its way in through the venture capital space, and money is finding its way into these markets. Otherwise, how are these things going up, right? What is it? CalPERS last week announced that after ignoring venture capital for so long, they're now going to start throwing money at venture capital. There's liquidity. There's liquidity to fuel that AI bubble at the VC level, right? With rates where they are and decreasing money supply, I do not believe this side has been fulfilled yet. There's a lot of money out there. I mean, just the sheer amount of money that exists, the amount of wealth that's been created over the last 50 years in the Western world, the sheer amount of wealth that's being created. We keep hearing about the amount of debt, but you have to look at the amount of wealth that North Americans have, and not the amount of debt. There's so much out there, and it all has to find a home. I don't know that you need a central bank and a government to create this liquidity when there's just these sheer massive big piles of wealth out there. And you're also moving into a major wealth transfer from one generation to the next. The generation that is expiring is the wealthiest generation ever. I don't know how many trillions it was. It was in the trillions that is being passed to the next generation. Well, that's going to be used, right? So I don't know that there's a lack of liquidity out there. Let's see. In answer to a question from June 4th, you made some comments about the origins of blockchain that sound like conspiracy theory. Yeah. Well, here's the thing. The reason, and it is a conspiracy theory, is if there was a guy who created this, what was the name on the paper? Yes, I forget the name now. Nakamoto, I forget. But anyways, if there was a name on a paper, somebody somewhere would have said, I think it's this person or that person, or somebody somewhere would have stepped forward. Somebody somewhere with a little too much sake would have said, hey, I'm the one who did that. Somebody somewhere. It would have been uncovered at some point. Somebody knew somebody who knew somebody that says, you know what, this guy was working on this for years. This sounds a lot like this guy. This was his original white paper. Like, you don't just show up out of nowhere with a paper. You've usually had a history of working in the space, writing in the space, attending conferences, going somewhere. You know, so this computer science conference, that's computer science, publishing in this journal, that journal. You'd be somewhere. You would have left footprints. But there were no footprints, nothing. So whoever put it out there was meant to never be known. And it is such a gift to criminal organizations that my thinking is maybe it was a criminal organization that did this, that put it out there, but they can't say. North Korea, for example, couldn't say, hey, we have this great thing we'd like the world to try. But it's a great way for him to avoid all of the global sanctions. Same with any criminal organization. So yeah, you know, it fits. Yeah, it's a conspiracy theory. But, you know, to not have any indication of who this person is after all this time, not even a clue, that nobody knows, to me, tells me that it's not a person, it was an organization. And it was an organization that would rather not know that rather not have anybody know that they did it, or it would lose all its credibility. And since then, it's been just a great, beautiful gift for that criminal organization. I agree with you that crypto is utterly worthless, but with all due respect, what is your motivation behind such extreme speculation? Well, I just gave it to you. Shouldn't we be more fact-based in our conclusions about the world? Well, you bring me a fact. I generally view your thoughts as insightful, so I'm generally curious about where this comes from. The lack of evidence sometimes is evidence, right? So what is the best way to track default in the private credit market? I don't know. Google it. Somebody somewhere is writing a story about it somewhere. Just Google it. It's interesting that the AI hype is only in the U.S. stock market, not anywhere else. Seems only U.S. can benefit from it. Well, no, it's in France. What was that AI company? No revenues, no nothing. Got funded 105 million. First round VC, 105 million. That's huge. Huge. So it is in other places. I have a question regarding the code of ethics and professional standards. Let's say I'm walking down the street and I see Warren Buffett have a stroke and dies right in front of me, and a couple more people. In front of me and a couple more people. Okay, the first thing I do is I short Berkshire. Would I be violating material non-public information? No. I don't. I can't see how that would be material non-public information if he's dying right out there in public. I know this might sound like a stupid question, but I just keep finding arguments for both sides, and the CFA Reddit forum wasn't that helpful. I don't think that qualifies as material non-public information at all. I think if you were at Berkshire's offices meeting with Warren Buffett in the boardroom, and he died in the boardroom with you, and before you told anybody, you went online and shorted the stock, and then you opened the door and said, help, we need help in here. Yeah, I think you did something. I think that crossed the line. But I mean, you had no meeting with him. You weren't there for any other reason. You just happened to be in a place where something happened and you observed it. I don't see how that is material non-public information when you're telling me he's dying right in a public place. No, I don't think so. So let's see. We'll pass on that one. I think that's just a comment. Comment here. I already asked this question and you answered, but I still can't wrap my head around it. Why equity market performance is important to the Fed? It's because it loosens financial conditions, right? Two reasons. Number one is when markets go up, it creates a wealth effect. And that wealth effect does affect savings rates and propensity to spend. As the market goes up, people feel wealthier, they feel richer, they're more willing to spend money today and save less because they think, oh, my portfolio will take care of my retirement. Things are going up. We're getting better. I can go back to my spending habits now. The other part of it is that the equity component increases relative to the debt component, such that debt equity ratios tend to fall, which introduces the potential for greater leverage if you want, because now you have room to add leverage. Firms don't borrow because their debt equity ratio is low. Yes, they do. Yes, they do. Firms will target a debt equity ratio. We have to think about level 2 and the value of the firm because of a number. Modigliani and Miller made a bunch of simplifying assumptions, saying that if these assumptions hold, then capital structure is meaningless for firm formation. They weren't advocating that. They were saying, if we know that the capital structure affects firm formation, and we know it must be one of these 7 things now, because as soon as we assume them away, it no longer matters, so it must be one of those 7 things. So we know that it matters. So there are firms that know that they can maximize the value of the firm by targeting a specific debt equity ratio. So if the value, if they target a, let's say, 30% debt, 70% equity, and they have a rally, and this goes to 0.2, 0.8, they will increase their debt to bring it back to 0.3, 0.7. They will issue debt. And they'll use it either to buy back stock or to fortress up their balance sheet, but they will issue debt. Or what they'll do for the next project, rather than finance it with 30% debt and 70% equity, to get their debt equity ratio back on their next project, they might finance it with 80% debt and 20% equity. So yes, they do. Firms absolutely do borrow to target a debt equity ratio. It's the ability to service the lenders are looking for not so debt. Well, no, that's not true either. And debt equity gives them their level of leverage, so they do look at that. Why are we watching S&P 500 on the screen while Powell is speaking? Well, because you want to see what effect it's having on asset prices. I mean, that's what we want to see, and it's giving us some idea of what the equity market believes based on what Powell is saying. Imagine there's one lender in the economy. If a firm borrows $1 from the lender and promised to return $1.20, where would that firm get the incremental 20 cents of interest if that lender is the only institution to create money? Well, from you. It borrows $1. It then combines it with $1 of equity. It buys a machine that produces 20 items, and then it sells it to you at a profit that pays for that pays for all its expenses. Every single penny a corporation spends either is shareholder money lost or consumer money gained. So when we say the consumer is 70% of the economy, I say the consumer is 100% of the economy, because every penny a government spends has got to come from the consumer at some point. Every penny a government spends has got to come from the consumer at some point, because where's it going to come from? You can say, oh, corporate taxes. Well, corporations only pay taxes when they're profitable, and they're profitable when they sell stuff. And in the end, everything has to be sold to a consumer at some point. Well, business to business, yeah, but then business to business becomes the other business's costs, which are then factored in the price of its product for the consumer. So if a corporation's paying taxes, it's because the consumer has given it so much money that it paid all its expenses and then some. And that's how it pays back its interest, right? It would probably not be efficient to have one bank in the economy, but that doesn't mean they can't create money, right? Remember now, everything has to balance on the banking book. So deposits come in. There's the dollar in deposits, and let's just assume that they can lend out everything they get, that there's no reserve banking here. So they lend out $1 to Joe, who then sets up an account and deposits $1. See where I'm going with that? Typically, he would, if we don't like the idea of Joe, let's do it a different way. Joe takes this $1 and he goes and buys a product from company A. Well, if there's only one bank in the city, this deposit belonged to Bill. Let's say. Actually, I don't like the name Bill. Let's say Bob. This deposit belonged to Bob. Well, so we lent money to Joe. Joe spent the money on product A, so this company also has a deposit. There's the dollar back, which means that they can lend out another dollar. So it's it doesn't have to go to another bank to create another deposit of loanable funds. So now you have $2 in deposits and you have $2 in loans. So if it looks like magic, sometimes it can be, right? Could the market be right about AI? I think it is right about AI. I think it's right about what AI, how important AI is. I think it's wrong in its valuation today for some of the companies that are how could we explain these companies? Like Nvidia is selling, the picks and shovels. If we think about the California gold rush, do you want to be one of the miners or do you want to be at base camp selling all the picks and shovels, right? The companies who sold picks and shovels made a lot of money, but not everyone who went hunting for gold made a lot of money. So Nvidia is selling picks and shovels. Well, at some point, you're going to be done selling picks and shovels, but their valuation is to the point where they'd have to be more than 100% of the market just to justify this price, right? So it's just the AI revolution, I think, is real, but the valuations are going to get way out of line because the story is going to get more and more dramatic each day. God is real and widely held conspiracies are true. Jeffrey Gunlock has been interpreting the same economic data as you, but you both seem to come to different conclusions. Wow, that's the world, right? Both of you interpret the economic data as grim, which leads both of you calling S&P 7 in a mania, S&P 493 flat, an equity market highly stretched at a 19, almost a 20 now. Here's where you differ, and I would love your thoughts on it. Jeff is arguing that due to those grim economic data points, especially when you look at ISM and PMI data points, where he argues it might already be in a recession in manufacturing, that the Fed is making the same mistake as last year, but in reverse. I don't think. Well, the Fed has made it clear that some economic pain is going to happen. They made it clear. And that they are squarely focused on inflation, and inflation hasn't done anything. So according to the Fed, they're not making any mistake because inflation, their mandate is price stability and full employment. Leading indicators pointing down, PMI is weak, still got full employment, right? You still got the Fed's not there to bail out an industry. Or to bail out, just the manufacturing sector, which is 18% of if you look at core, I think it's 72% or 78%, and the manufacturing sector is 18% of that. It's not there just to bail out one industry or one sector. Full employment, price stability. Full employment is checked. Lowest unemployment in 50 years. We're good with wages growing. At the last ECI was 4.8% above the long-term average. There's no problem to solve there. There's no problem to solve there. Inflation is the problem. So that he thinks it's a mistake the Fed's not rushing to save manufacturing. That's not the Fed's mandate. And they did say there'll be some economic pain, and they are not there to run and prop up industries or sectors. So I think he might be hoping for too much there. Such grim economic data points, the Fed may be overdoing it and more likely to break something. I don't think they're overdoing it. If you look at how the economy is responding, other than manufacturing, which is interest rate sensitive, look at housing. It's in expansion mode now. It's expanding. Quite significantly. If you look at the jobs market, great wage gains and robust market. You want a job, there's a job for you. The only reason you're unemployed right now is you simply just aren't trying very hard. So I don't even think the interest rates are working that much. I think if you want the interest rate to work on demand, you got to go another 200, 300, maybe even 400 basis points higher than where we are, because we're certainly not at the neutral rate. If you have this kind of economy and this kind of market, you are not at the neutral rate. And this kind of housing market, there's no way we're at the neutral rate. I don't know why he's so grim about that. Headline CPI is coming down. Who cares? Headline is made up of two very volatile components, food and energy. They're volatile. That's why we take them out, because you don't want to make mistakes with interest rates by paying attention just when gas prices and food prices go up. And you raise rates and then, then they come right back down as soon as supplies. Then you got to lower it. You don't chase those volatile components. We always look at core. So headline, who cares about headline? He feels that will continue until 3%. Who cares? Who cares if headline goes to 3%? It's core that matters, right? Equity markets are not loose financial conditions because there are only 7 stocks carrying the market. Okay, well, there I can give him something. I can give him something there. M2 is the lowest since Great Depression. No, that's not true. That is just not true. That's a lie. M2 is not the lowest since the Great Depression. M2 growth is the lowest. The sheer volume of money out there is the highest it's ever been, other than when it was higher just recently. But if you go back through history, given where we are in M2, there is no lack of money supply. It's just the money supply is shrinking from a very, very high level. It is not the lowest it's been since the Great Depression. It's the lowest growth rate, which is negative right now, since the Great Depression. If you want to look at it that way in terms of a growth rate, yes, it's contracting faster than then, but from a super high level now. So no, that is not true. And core CPI is a lagging indicator. Yeah, it is a lagging indicator. It's year over year. You're right, that is a lagging indicator, but we look at it for a couple of reasons. Number one is a lot of wages are tied to CPI. So you have to wait for the year to be over, and then the wage gain is tied to that previous amount. Not only that, some expectations, especially pricing and contracts, especially union contracts, have a big tie to that. Social Security and any pension payments are tied to that as well. So while it's a lagging indicator, it has an effect for what we're going to see when prices adjust to it. So it is important. Also, this also sets the expectation going forward. What you can do is you can take the 1 month, the month over month, and annualize it. You'll get a very noisy number. You can take the last 3 months and annualize it. You'll get a slightly less noisy number. But there are 1 month, 3 month, 6 month annualized CPI, meaning let's just take the last month and say, well, if it stays this way for the next 12 months, let's look at it. But the lag part here is important because a lot of contracts are tied to that index. So a lot of pricing formulas are tied to that index. So when you see 5.3 core for the past year, you know that 5.3 is being priced into some things right now. Or it could be CPI plus 100 basis points being priced in. It could be a union contract with a wage escalator that says it's 3% a year plus the CPI. Whatever it could be, some particular measure of the CPI. It could be the trimmed mean CPI or something, but there's a lot of contracts that are tied to a measure of CPI after the fact, not before the fact, because you don't know what it is, but after the fact. So it is important. So it's not that yes, it is a lagging indicator, but it's not a lagging effect. Okay? In light of these data points, why shouldn't the Fed stop hiking, or better yet, squeeze in a cut this year? Why? Let's say that you had 2 jobs to do. One was clean the kitchen, right? And the other is to cut the grass. And I walk in the kitchen, and the kitchen's clean, but the grass is not cut yet. And I come after you and I say, well, why wouldn't, the grass is not that bad. Why wouldn't you just clean the kitchen some more? Well, I just did. The kitchen's clean. So a clean kitchen is full employment, and the grass is price stability. Well, you have the lowest unemployment in 50 years. You have an ECI coming in at 4.8%. You have, 1.8 jobs open for everybody that's looking for work right now. And you have job gains every single month. Well, what do you want them to do? Like, what part of this do you feel is not satisfied yet? It should be the lowest in 70 years. They've got more work to do. It should be the lowest in 70 years. There should be 2 jobs open for every worker. There should be even bigger job gain. Like, what part of this do you feel the Fed has not satisfied? Now, if we look at price stability and looking at core, trailing core at 5.3, and you looked at these 2 things, which one would you say needs to be done? You walk into the house, you told your son, you clean the kitchen, cut the grass. You come home, you see the grass is not cut, you walk in, you see the kitchen's cut. Would you order him back into the kitchen? Or would you order him outside to cut the grass? The grass needs to be cut. The Fed knows what it needs to do, and I think it's doing the right thing. And Jeff kept mentioning the Fed should be looking at high-frequency data points. Can you explain what this is? That's data points that happen more often. So, something that you can see maybe on a daily basis or a weekly basis as opposed to quarterly. Like ECI is low frequency, and we only see that quarterly. This is somebody who desperately wants a bull market, right? So, I don't know what he's investing in or anything much about him. But if he's investing in parts of the economy that require a lot of speculation, let's say that he's a big crypto bull, that requires a lot of easy money and speculation. So what he's trying to say is, I need a bull market, and this is everything the Fed is doing to not give me my bull market in the sectors that I want. He just, he sounds like he desperately would want a bull market, and that maybe his whatever strategy he uses desperately needs a bull market. But some of the things he's saying are very, I'd say, naive in a sense. If he is saying these things, it's naive and half-truths, basically. I don't know if that helps you. Too much uncertainty. Put all my cash in his ETF. I don't know what that is, but... Yeah, washing machine. I appreciate the effort, but it sounds like it's your problem that you just can't understand the new jibber-jabber language. That is a new language then. Then you got it. And it probably is my problem. And that takes us through it.